Right now, somewhere in the basement floors of the Saudi Arabian Monetary Authority in Riyadh, a quiet accounting decision is being finalized. It does not involve a missile launch. There is no satellite imagery. No Reuters alert will flag it. But this decision, about which currency to denominate a natural gas contract in, will do more lasting damage to American financial power than any military confrontation in the last decade. This is not a hypothetical. In March 2023, Saudi Arabia confirmed it was open to settling oil trades in currencies other than the US dollar for the first time in 50 years. In 2024, the BRICS nations, Brazil, Russia, India, China, and South Africa, now expanded to include Saudi Arabia, the UAE, Iran, Ethiopia, and Egypt, formally discussed a settlement framework that bypasses the dollar entirely. And as of early 2025, roughly 47% of China's cross-border transactions were being settled in yuan, up from under 15% in 2020. The shift is not coming. The shift is already happening. Here's what the mainstream media is not telling you. The dollar's reserve currency status is not a fixed feature of the global economy. It is a political arrangement sustained by trust, by habit, and by the credible belief that there is no alternative. That belief is now being methodically dismantled, not by one adversary, not in one dramatic moment, but through a slow and deliberate rewiring of the global financial plumbing that America built after World War II. By the end of this video, you will understand exactly three things. First, how the petrodollar system was constructed, and what structural mechanisms actually give the dollar its power. Second, the precise sequence of events, dates, decisions, and defections that has brought that system to its current point of fragility. And third, what happens to the price of your mortgage, your groceries, and your government's ability to borrow money if the dollar loses even 20% of its reserve share. Stay with me, because the numbers here are not abstract, and the timeline is shorter than almost anyone in official Washington is willing to admit publicly. Context layer 2-6 min Cox 800 words. To understand what just happened, you have to go back to July 1944 and to a resort hotel in Bretton Woods, New Hampshire, where 37 delegates from 44 allied nations signed an agreement that would define the architecture of the global economy for the next 80 years. The deal was elegant in its simplicity. The US dollar would be pegged to gold at $35 per ounce. Every other major currency would be pegged to the dollar. The United States, which held approximately 65% of the world's gold reserves at that moment, would serve as the anchor of the entire system. In exchange, the US gained something extraordinary, the ability to print the world's reserve currency, which meant it could run trade deficits and borrow money at terms no other nation could access. Economists call this the exorbitant privilege. It is the single greatest structural advantage in the history of modern finance. That system fractured in August 1971 when President Nixon suspended dollar-gold convertibility in what became known as the Nixon shock. But the dollar did not collapse. Instead, the Nixon administration and Secretary of State Henry Kissinger engineered something more durable, the petrodollar system. The mechanism was this. In 1973 and 1974, the United States reached a series of agreements with Saudi Arabia. The Saudis would price their oil exclusively in US dollars. In exchange, the United States would provide military security guarantees and purchase Saudi government debt. Within 3 years, OPEC as a whole had adopted dollar-only pricing. Because every nation on Earth needs energy, and energy was now priced in dollars, every nation on Earth now needed to hold dollar reserves. The demand for dollars became structural, self-reinforcing, and for 5 decades, seemingly unbreakable. Let me put this in concrete terms. When Japan buys oil from Saudi Arabia, it first has to earn or acquire dollars. When India settles a crude cargo, it pays in dollars. When Vietnam refinances its foreign debt, it does so in a currency it does not issue and cannot print. This is the hidden tax that the petrodollar imposes on the rest of the world. And for 50 years, the rest of the world paid it because the alternatives were worse. Then came a sequence of decisions that in retrospect began to erode that consensus. The first was the 2003 invasion of Iraq. Whatever one believes about this strategic rationale, the effect on global trust and American institutional judgment was measurable and lasting. The second was the 2008 financial crisis, in which financial instruments denominated in dollars, AAA rated by American agencies, turned out to be catastrophically mispriced, costing sovereign wealth funds from Norway to Singapore hundreds of billions. The third, and most consequential, was the weaponization of the dollar payment system following Russia's invasion of Ukraine in February 2022. When the United States and its European allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions, something fundamental shifted in the calculations of central banks around the world. The message received in Beijing, Riyadh, New Delhi, and Abu Dhabi was not subtle. The dollar was not merely a neutral medium of exchange. It was an instrument of American foreign policy. And if your interests diverged from Washington's, your reserves were potentially at risk. Watch what happened next. In 2022, China and Russia settled over 65% of their bilateral trade in rubles and yuan, up from under 30% before the Ukraine sanctions. In November 2022, Chinese President Xi Jinping traveled to Riyadh and publicly called for Gulf oil sales to be priced in yuan, a statement that would have been unthinkable from a Saudi partner 12 months earlier. In 2023, Brazil and China agreed to settle bilateral trade in their own currencies, removing the dollar from one of the largest South-South trade relationships on Earth. And in August 2023, at the Johannesburg BRICS Summit, the bloc formally invited 6 new members, including Saudi Arabia and the UAE, the 2 nations whose oil pricing decisions are most critical to the petrodollar's survival. The petrodollar system that existed before February 2022 is not coming back. The question now is not whether it will erode. The question is how fast and what that erosion costs the average American household. Let us now examine the architecture of what is actually changing. Military analysis, 6 to 10 minutes war, 900 words. This section of the dollar war has no missiles. But it does have weapons, and they are more sophisticated than most military hardware. The primary instrument being deployed against dollar dominance is the payment system. And here's something that no financial analyst had fully anticipated before 2022. The speed at which alternative payment architecture can be constructed when a major power is sufficiently motivated. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is the messaging system that underlies the vast majority of international financial transactions. It connects over 11,000 financial institutions in more than 200 countries. When the U.S. removed Russia from SWIFT in March 2022, it demonstrated that control of this infrastructure is a genuine lever of geopolitical power, but that demonstration also served as a global advertisement for alternatives. China's cross-border interbank payment system, known as CIPS, was launched in 2015 and processed approximately $14. $8 trillion in transactions in 2022, a figure that grew by over 21% in 2023. It is not yet remotely close to SWIFT in scale, but its growth rate is the signal that matters. Russia's own SPFS system, developed after its initial Crimea-related financial sanctions in 2014, now connects over 550 financial institutions and has been adopted by a growing number of Central Asian and Middle Eastern banks seeking SWIFT redundancy. Here's what military strategists are actually saying. And by military strategists here, I mean the economists and national security analysts at the RAND Corporation, the Atlantic Council, and within the Federal Reserve itself. The real vulnerability is not that SWIFT gets replaced tomorrow. It is that a parallel system gets built to a threshold level of functionality, perhaps handling 20 to 25% of global trade, at which point the coercive power of dollar exclusion drops precipitously. If you can route around the sanction loses its deterrent value. That threshold is closer than the public debate acknowledges. The second weapon is the digital currency. China's digital yuan, the ECNY, has now been piloted in over 25 Chinese cities and used in cross-border transactions with Hong Kong, Thailand, and the UAE under a project called mBridge. The Bank for International Settlements, which is not a geopolitical actor, described mBridge in its 2023 report as the most advanced cross-border CBDC platform in the world. The significance is technical, but important. A central bank digital currency that settles cross-border transactions without touching the dollar payment rails removes the structural necessity of holding dollar reserves for trade settlement entirely. The third weapon is gold. Central bank gold purchases hit a 55-year record in 2022, 1,136 metric tons, and remained near those levels through 2023 and 2024. The largest buyers were China, Russia, Turkey, India, and Poland. This is not coincidence. Central banks diversifying into gold are explicitly reducing their exposure to dollar-denominated assets. The People's Bank of China has added gold to its reserves for 17 consecutive months as of early 2025, and China's publicly reported gold holdings are almost certainly an undercount, as Chinese state entities hold gold through vehicles not captured in official central bank reporting. What does this reveal about capability gaps? Here is the honest assessment. The dollar still processes approximately 58% of global foreign exchange reserves and 42% of global SWIFT transactions. Those numbers were 71% and 55% respectively in 2001. The trajectory is unmistakable, but the distance still to travel is significant. The dollar is not being overthrown this year or next year, but the architecture of a post-dollar settlement layer is being built in real time, and the builders have both the motive and, increasingly, the technical means. The options now on the table for Washington are fewer than they were 3 years ago. Tightening dollar access further, extending sanctions to more actors, risks accelerating the diversification it is meant to deter. Loosening sanctions would undermine their credibility as a deterrent entirely. Competing on the digital currency front requires a level of U.S. Treasury and Federal Reserve coordination that the existing institutional structure makes extremely difficult. And the most powerful tool, restoring the trust that the reserve freeze of 2022 damaged, is not a policy lever. Trust, once questioned at this scale, is rebuilt over decades, not quarters. Economic consequence cascade 10, 14 min c 900 words. Let me put this in concrete terms because this is where the story reaches into your household. The immediate market reaction to dollar reserve erosion is not a crash. It is more insidious than that. It is a slow, sustained increase in U.S. Treasury borrowing costs. Here is the mechanism. The United States government currently carries a national debt of approximately $5 trillion. To finance that debt, it sells Treasury bonds. Foreign central banks and sovereign wealth funds are the largest buyers of those bonds, or were. In 2014, foreign holders owned approximately 34% of outstanding U.S. Treasuries. By 2024, that figure had declined to under 23%. As foreign demand for treasuries declines, the U.S. must either find domestic buyers, which means higher interest rates to attract them, or the Federal Reserve must step in as buyer of last resort, which is inflationary. This is not a theoretical problem. The 10-year Treasury yield, which was 5% in early 2022, rose to over 5% by October 2023, a 33-year high, before partially retreating. Analysts at Goldman Sachs and JP Morgan have separately estimated that if foreign Treasury holdings decline by a further 10 percentage points of the outstanding stock, the structural upward pressure on 10-year yields could be between 40 and 80 basis points above what inflation alone would justify. That number might sound abstract. It is not. An 80 basis point increase in the 10-year Treasury yield, sustained, translates to roughly an additional $200 per month on a $400,000 30-year mortgage. It translates to higher auto loan rates, higher corporate borrowing costs, and ultimately higher prices for every product sold by a company that relies on credit to manage its inventory. The transmission mechanism through energy markets is equally direct. If oil begins to be priced in a basket of currencies, even partially, the U.S. loses what economists call the dollar recycling effect. When oil exporters sell crude in dollars, they take those dollars and invest them in dollar-denominated assets, primarily treasuries. This recycling sustains demand for U.S. government debt. Break the cycle even partially, and the structural bid for treasuries weakens further. Brent crude was trading at approximately $73 per barrel in early 2024. Models from the BIS suggest that a full delinking of oil pricing from the dollar could add $8 to $15 per barrel in effective U.S. energy costs over a transition period, as the hedging premium and reduced recycling flow increase the import cost in dollar terms. The downstream industries most affected are predictable but worth naming precisely. Airlines which hedge fuel costs in dollars would face higher effective fuel bills. Shipping companies that price freight in dollars, and here I mean the container lines on the Asia-Pacific routes, where roughly 42% of global trade by volume moves, would face both currency volatility and higher financing costs. Agricultural exporters, who currently benefit from dollar-denominated grain and fertilizer markets, would face greater pricing uncertainty. The Kansas farmer and the Iowa soybean grower are directly affected by the stability of dollar-denominated commodity pricing. A structural shift in those pricing conventions is a supply chain disruption without a single news event attached to it. The countries most exposed in the transition period are those who currently hold large dollar reserves against short import cover. Japan holds approximately $3 trillion in foreign exchange reserves, with import cover of roughly 22 months, significant cushion. India holds reserves covering approximately 10 months of imports, a buffer that is adequate under current conditions, but thin if global dollar liquidity tightens rapidly. South Korea holds reserves covering roughly 7 months of imports. In a scenario where dollar access becomes constrained or more expensive, South Korea's position becomes uncomfortable quickly. Pakistan, to name a country closer to a genuine crisis, has at times held reserves covering fewer than 30 days of imports, a situation where any disruption to dollar access is existential. This is not abstract economics. This is a direct line from the rewiring of global payment systems to the price of food at a Pakistani market, to the interest rate on an American home, to the cost of filling a tank at a petrol station in Seoul. If you want to understand how these shifts hit your economy before the mainstream media catches up, because this story will not be front-page news until it is too late to prepare, make sure you are subscribed. The pattern always emerges in the data before it emerges in the headlines. Diplomatic chessboard, 1417 min 600 words. Now let us examine who is actually talking to whom and what each party needs to be able to say to their own people. The United States' diplomatic posture on dollar dominance has been, until very recently, a combination of confident dismissal and quiet alarm. Publicly, Treasury officials maintain that the dollar's reserve share is stable and that no credible alternative exists. Privately, the Federal Reserve's own research division has published working papers acknowledging the long-term erosion trend with a candor that the official public statements do not match. Saudi Arabia is the pivot. Riyadh has moved with remarkable diplomatic dexterity, deepening its security relationship with the United States, the F-15 upgrade agreement signed in late 2023, and the ongoing discussions around a formal U.S. defense treaty, while simultaneously expanding its engagement with China, its largest oil customer. The Saudi government needs to tell its domestic audience that it is modernizing, diversifying, and refusing to be taken for granted by any single power. Opening the door to yuan-denominated oil sales is not an abandonment of the U.S. alliance. It is a negotiating position and a very effective one. China's red line is simple. It will not accept a global financial architecture that can be used to isolate it the way Russia was isolated. Every yuan-denominated trade deal, every CIPS expansion, every Enbridge pilot transaction is an insurance policy against that scenario. Beijing does not need the yuan to replace the dollar. It needs the yuan to be sufficiently internationalized that dollar exclusion is not a strategic weapon that can be used against it with full effect. That is a materially lower threshold than dollar replacement, and it is closer to being achieved than Washington acknowledges. Russia's position is the most constrained. Having been effectively expelled from the dollar system, Moscow is now the test case for whether a major economy can function in dollar isolation. The answer so far is, with significant pain, but yes, because China and India between them absorb enough Russian energy to sustain the export revenues that matter most. Russia's public position is that de-dollarization is inevitable and that the West's sanctions have accelerated it. That is partially true, and Russian officials are not above overstating it for domestic political purposes, but the directional claim is accurate. The unexpected mediators in this story are Oman and the UAE. Oman has historically served as a back channel between the United States and Iran, and more recently has facilitated quiet discussions between U.S. Treasury officials and Gulf financial institutions navigating the space between dollar compliance and yuan exposure. The UAE, particularly Abu Dhabi and the ADGM Financial Center, has positioned itself as the world's premier regulatory arbitrage zone for institutions that need to manage both dollar and non-dollar relationships simultaneously. If there is a transitional architecture being road-tested in real time, it runs through the UAE's financial system. What each side needs to tell its domestic audience is the crucial constraint. Washington needs to say that the dollar is strong and the system is working. Beijing needs to say that China is achieving financial sovereignty without triggering confrontation. Riyadh needs to say that Saudi Arabia is maximizing its leverage in a multipolar world. The gap between those public positions and the private reality is where the real diplomatic work is happening, and very little of that work is visible in official statements. Escalation scenarios 1720 minute 700 words. Let me now walk through 3 scenarios. These are not predictions. They are the 3 structural paths that analysts see as plausible, and they differ substantially in what they cost and who pays. The first scenario is managed transition. In this scenario, the United States, over a period of roughly a decade, accepts a gradual reduction in the dollar's reserve share, from the current 58% to somewhere in the range of 40 to 45%, while the euro, yuan, and a small number of regional currencies absorb the remainder. This is not dollar collapse. It is dollar normalization. The precedent exists. The British pound sterling was the world's dominant reserve currency from roughly 1815 to 1945, and its decline, while painful for the UK, did not produce global financial collapse. It produced a rebalancing. What this requires from the US side is significant. A willingness to run smaller budget deficits, since the structural foreign demand for treasuries that currently subsidizes US borrowing will be lower. It requires engaging constructively with digital currency frameworks rather than treating them exclusively as a security threat. And it requires a foreign policy that rebuilds some of the institutional trust that the 2022 reserve freeze damaged. This path is possible. It requires political decisions that the current institutional structure makes very difficult, but it is the scenario where American living standards adjust rather than collapse. The second scenario is continued attrition. In this scenario, the United States does not make the structural fiscal adjustments that managed transition requires. Dollar reserve share continues to decline at roughly 1 to 2 percentage points per year. U.S. Treasury yields remain structurally elevated, in the 5 to 5% range on the 10-year, as foreign demand continues to weaken. The Federal Reserve faces a permanent tension between fighting inflation and supporting Treasury market function. Week by week, the cost accumulates. Each point of additional yield on $34 trillion in debt is approximately $340 billion per year in additional interest expense. Within this scenario, the U.S. federal government's interest costs, already the single largest line item in the federal budget at over $900 billion annually, could reach $1, $4 trillion per year by 2027 under plausible yield assumptions. That number crowds out defense spending, social programs, and infrastructure simultaneously. The economy does not crash. It slows, grinds, and loses ground. and the political consequences of that slow grinding may be as destabilizing as any market event. The third scenario is the one that strategic analysts discuss privately, but governments will not name in public. This is the scenario that keeps strategic analysts awake at night. It begins with a geopolitical trigger, most likely either a Taiwan crisis or a major escalation in Middle Eastern conflict, that causes a rapid and disorderly movement out of dollar assets. A disorderly move need not be large to be catastrophic. Foreign central banks hold approximately $7, $8 trillion in U.S. Treasury securities. If 15% of that, roughly $1, $2 trillion, were to be liquidated in a 6 to 12-month period, the Federal Reserve would face a choice between allowing yields to spike to levels that would crash the U.S. housing market and corporate debt market simultaneously, or intervening with money creation at a scale that would be overtly inflationary. That threshold has now been crossed from theoretical to plausible, and the financial stability reports from institutions including the IMF, the BIS, and the Bank of England have all, in varying degrees of explicitness, flagged it. In this scenario, the contagion is global. Countries holding dollar reserves see those reserves lose purchasing power simultaneously. The international monetary system does not have a functioning alternative architecture to catch the fall. The human cost, measured in food prices, debt crises, and development program collapses in the world's poorest economies, would be enormous and asymmetric. The countries that cannot absorb the shock are not the United States. They are the ones that never had a choice about holding dollars in the first place. Close, 2022 min do 500 words. Let me bring this back to where it belongs, to the concrete, immediate, everyday reality of what the dollar war means for the people watching this video. Watch the 10-year Treasury yield. When it rises without a corresponding rise in inflation expectations, that is the signal that foreign demand for U.S. debt is weakening. Watch the dollar's share of global foreign exchange reserves as reported in the IMF's COFR database, updated quarterly. It is public data, and it tells you more about the actual trajectory of dollar power than any official statement. Watch the pace of SIPS and M-Bridge expansion, transaction volumes, the number of participating institutions, the addition of new currencies to the settlement framework. These three numbers, tracked month by month, will tell you where this story is going before the headline writers do. The direct line from this story to your daily life runs through 5 everyday experiences. Your mortgage rate is priced off the 10-year Treasury yield, and that yield is increasingly set by a foreign demand signal that Washington does not fully control. The price of fuel at the pump is priced off global oil markets that are beginning, incrementally, to denominate in something other than dollars. And that process adds friction and cost to every barrel that reaches a U.S. refinery. The interest rate on your car loan, your small business credit line, your government's ability to invest in roads and schools and hospitals without raising your taxes, all of these are downstream of the dollar's ability to sustain the structural demand that 50 years of petrodollar architecture created. The cost of imported electronics, clothing, and food, priced in global supply chains that are rewiring their currency exposure, will be affected as that rewiring increases volatility and hedging costs. And your government's capacity to respond to the next crisis, the next pandemic, the next financial shock, the next major conflict, depends on its ability to borrow cheaply and quickly, a capacity that is directly proportional to how much the world still wants to hold dollars. The reserve currency system that existed before February 2022 is not coming back. The question that this video cannot answer, because no one can answer it honestly, is whether the transition ahead is managed or disorderly. Whether it takes 15 years or 5, whether the institutions being built in Riyadh and Shanghai and Abu Dhabi achieve the critical mass needed to serve as genuine alternatives, or whether they remain peripheral and the dollar adjusts and adapts. Those outcomes are not yet determined. They will be shaped by decisions being made right now in central banks and finance ministries and diplomatic back channels that rarely make the front page. And that is the question that the next video will begin to answer. What, specifically, are the policy options that remain, and which ones does Washington still have the political capacity to execute? Because there is a window. It is narrowing, and understanding it is the difference between reacting to history and being prepared for it. If this video helped you understand what is actually happening, not the headlines, not the noise, but the full picture, share it with someone who needs to see it.